Hi and welcome to SeavorCharted's budget special. Today we're going to go over the budget, which we literally an hour after finish watching and reviewing, and we'll go through the key highlights, the things that are going to affect our clients, people in business, people who own properties, and we'll go through the relevant tax changes that are going to impact you. So to start with, Sarah, would you be able to give us a backdrop, what you think leading up to this budget?
Yeah, well, as Graeme said, we have just finished watching the Chancellor's second budget, and to begin with, she did start off quite irate, and I think that was to do with...
Yeah, she was aggressive, wasn't she?
Yeah, very aggressive, and it was probably as a result of the OBR releasing the documents, leaking them documents out ahead of time. But to be fair, that's in keeping with exactly what's happened around all the noise of the budget so far. So many items being released and leaked ahead of time. So it was really important actually to get this speech out the way and see it actually come off.
And give some businesses some clarity of what's going on, because I know from my perspective, the clients I've spoken to, I suppose it's really late, isn't it? Having this budget literally the last Wednesday in November. We were expecting it in early October, and that's just given more time for the rumour mill. We did a podcast earlier, I think it was in October time, just talking about all the rumours we'd heard even at that point, and I suppose it just built up, a lot of anxiety potentially for people in business, small businesses, wondering what they're going to get hit with when the budget came round.
Yeah. Lots of meetings that I've had in the run up to it, people were just so uncertain, and they wanted to wait until today to see what was happening before they can then make a decision going forward. So in a sense, a relief to get it out of the way, and let's have a see, look at the detail.
So I suppose my initial reaction to the budget is it could have been worse. However, now I've had time to take a step back and I've seen the breadth of tax changes. It seems to be across everywhere. The tax increases, from workers, pensioners, on savings, investments, for property owners. Even if you want to enjoy a milkshake, it seems like there's been a tax increase. So, where I thought it could be worse, potentially that is just because of the build-up there's been, the variety of rumours, the severity of those rumours, has almost given me this perception that it could have been worse, where actually when I have taken the time to digest what's been announced, I think there's a lot of tax increases in there, and more challenges for business. I'm trying to look for the good things for the businesses that we act for. A couple of key points as well I would just like to touch on, I suppose, is it was mentioned about the national debt, 2.6 trillion, and £1 in every £10 that the government currently spends is just on servicing the debt, the interest on that debt. That's a significant amount of tax take where it's going. You can understand, I suppose, why we need to make some changes, because we need to get that down. It's not sustainable to continue paying that level of interest each year.
It's just a number that you can't even comprehend, is it? 2.6 trillion is unreal, isn't it? So no wonder, there is this black hole, and she's going to have to, increase taxes, increase revenue to cover that. Yeah. And it seems, we haven't looked at the absolute detail, but it seems that she's increased taxes on lots of different areas to try and make up for that. And
if you were a business, considering your, 10% of your business income's on interest, that's a significant amount, isn't it? Yeah. So, should we have a look at some of the key tax changes, and then we can get into a bit more detail in terms of how they impact businesses and individuals.
So the tax headlines that matter, we've got tax increases right across the board. We've got the tax thresholds frozen, which was anticipated, but at least today it has been confirmed that those are frozen until 2031. We've got 2% increase tax on dividends, property and savings income. And we've also got the changes to EV and fuel duty to consider as well.
And I suppose some of those were heavily tipped, weren't they, prior to the budget announcements today. So now we've talked about the key headlines from the budget, and we can break that down, I suppose, have a specific look at businesses, and then we can have a look at what the impact is on individuals. So I suppose for businesses...
Yeah, so what businesses need to know, so we know that they've got to consider corporation tax, their dividends, capital allowances, business rates and the national minimum wage rates and apprenticeships impact. So do you want to mention about the corporation tax?
Yeah, so I suppose the budget, there was no changes mentioned to the rate of corporation tax, which I think's a good thing, and businesses will appreciate that. Yes, we'd love reductions in the main rate and lower rate of corporation tax. However, I suppose with the backdrop, you know, at least they haven't increased. The main rate will stay at 25% and the lower rate at 19%. Yep, so no more concerning things to think about for corporation tax.
Yeah, and I suppose linking with that in terms of companies, you've got owner managers who are often paid by way of dividends. There was that increase to 2 percentage points. That's going to apply from April 2026. So, you know, people that are paid by way of a dividend will have to take that into account, that from April 2026, they're going to pay 2 percentage points more. So the basic rate threshold from 8.75% to 10.75%, and the higher rate threshold from 33.75% to 35.75%.
Yeah, and I suppose the interesting thing about that as well is the 2% rate's been added on to the dividends, hasn't it, from April next year. But the additional rate, that's when your total income's above 125,000, that dividend rate is unchanged, which is, I'm going to say, is a bit unusual, especially as it's almost that we've added 2% to dividends, 2% to rental income or profits, and 2% to savings, but we've decided that dividends for the highest earners, that rate doesn't increase. Currently wouldn't understand the reason behind that. Maybe when we get to consider the detail a bit further, we'll get the understanding behind that. Certainly for some higher earners that we act for, I know that they'll be pleased that rate hasn't gone up. I did actually do some other calculations on that, and I suppose, you know, a lot of clients that we work with, they want to max out their basic rate band, so they take the total income up to 50,000 or 50,270. And I suppose that change in dividends there is going to result in a £750 extra tax to pay per year, that 2% increase. So it's not a negligible amount if you're considering a couple that run a business and each one of them kind of get paid in that way. You know, it's a bit of money out of the family budget.
It is, absolutely.
Yeah.
So capital allowances next. So there has been a reduction, or will be a reduction, on the writing down allowance for the main rate assets. So your general main rate assets such as plant and machinery and things, the writing down allowance will reduce from 18% to 14%. They've sort of tried to balance that out with this introduction of a first year allowance from April 2026, I think. So yeah, 40% first year allowance on main rate assets again, but no, it doesn't include cars, second-hand assets, or assets that you purchase for leasing overseas. They don't qualify for that 40%.
It's an interesting one, that, isn't it? And I suppose it affects just the largest businesses, because you've got your annual investment allowance, haven't you? You've got your AIAs, which is already a threshold of £1 million. And what that means is the first £1 million of capital expenditure, you're getting 100% allowance on it. So, you know, if you've bought a van and you've got 100% tax relief on that in the year of purchase, it doesn't even go into a pool to get those written down allowances. So it's only really going to affect the largest businesses making substantial capital investments.
So business rates is a big cost for business. So what did you pick up on that?
Yeah, well, that was I suppose, pre-budget. There was, you know, fundamentally a lot of people in the industry, in terms of tax professionals, are saying business rate is an area that just really needs looked at, and probably a full overhaul, but that hasn't happened. The key thing that has been mentioned is that there's going to be permanent support provided to retail, hospitality and leisure businesses. I know during COVID they got specific support for their business rates, and they've still been getting that. The way the relief's going to be given is going to change. It's not going to just be a percentage deduction on the rates that they pay. It looks like the multiplier that's used to calculate the rate is going to be 5p less for businesses in those sectors than for businesses in other sectors. And then there is almost, how's that going to be paid for? They mentioned those with larger premises ultimately are going to pay a higher rate, potentially business rates, although there's going to be some sort of transitional relief so that you don't go from 1 year paying business rates and a significant jump in a following year. But ultimately those with the largest premises, the Chancellor, I believe, mentioned like internet sales companies with large warehouses, let's just say, basically it's to try and get those to pay higher business rates. The next, I suppose, big announcement that's affecting businesses as well then, national minimum wage increases and apprenticeships.
Yeah.
What do you think?
Yeah, so this was one of the leaked items the day before the budget, wasn't it? And
Yeah.
it is welcomed if sort of for your lower earners, absolutely. So the rates are going to be from 21-year-old and over from April 2026. It's going from £12.21 an hour to £12.71 an hour.
Yeah.
If you're age 18 to 20, it's going from £10 an hour to £10.85 an hour,
Yeah.
and under
Yeah.
18, £7.55 to £8 an hour.
Yeah.
So although the headline rate was your over 21-year-olds, an increase of 4.1%, actually, age between 18 and 20, that's an increase of 8.5%. So your lower earners, they should have welcomed that absolutely for that increase.
And I think no business owner I've ever worked with begrudges people earning close to the national minimum wage.
Yeah.
You know, increases ultimately, the business owners I work with, they want all their earners to earn more money, but we can't hide from the challenges this is going to give to a lot of businesses. And yes, it's a national minimum wage increase, but it's all relative. There's a ladder of salaries and things. So I suppose what that means is, 4.1% increase straight away, that's a significant increase in cost. And for employers that have got a high percentage of 18 to 20-year-olds, that's going to be a significant jump potentially in their wage bill, 16.3% year on year for individuals in that age category. And that's on top of, 8.5% increase for this year. It's on top of a 16.3% increase last year.
Previous, yeah.
So if you look over a 2-year period and you're in the 18 to 20-year-old category, it's a significant increase, isn't it, for employers to cover. And I did some workings again, and I suppose just to put that into perspective, national minimum wage, if you did a 37.5-hour week for a 21-year-old and over, that is now a salary of just short of 25,000, and it's a £975 increase on the previous year. And for 18 to 20-year-olds, it's just over 21,000, and that's a £1,658 increase year on year. That's a significant amount if you have a lot of people in that category that are in that age range.
From the employer's perspective, and you've got the employer's national insurance to add on to that as well, haven't you? So,
Absolutely, and that was already a big hit, isn't it? So, straight away I think about what sectors is that going to impact high, and hospitality just rings out there that's going to, this budget again I think is going to add a lot of challenges for that sector where they've already struggling with pressures across the board.
Yeah.
So we've discussed some of the key changes for businesses from today's budget. I suppose what would you recommend, Sarah, to businesses to keep on top of those changes and how they impact them?
Well, there's some huge changes to a lot of people, and a lot of businesses will naturally be concerned how they're going to navigate through them. And it is really important about planning ahead and almost forecasting and think, right, this change from April, what's it going to look like? And I suppose that ties in nicely in terms of making tax digital from April 2026. A lot of businesses are already making tax digital compliant, but for sole traders and property owners, from April 2026, they're going to have to be making tax digital compliance. That means installing accountancy software such as Xero, which we recommend. We use ourselves, a lot of our clients do, and they can utilise that software to their advantage, producing real-time information, doing some forecasting, looking at the figures and planning ahead, and just making sure cash flow will be absolutely key for some businesses.
Well, I suppose some of these taxes, it's going to affect margins if you're a labour-heavy business, and you need to factor that into your profitability and understanding how it impacts it. And I think that's the best way to manage the changes, isn't it?
Yeah.
So I suppose leading on from that, should we have a think about have a look about the changes that impacted individuals from today's budget announcements?
Yeah, so the main impact is definitely the freezing of the tax
drag.
thresholds, absolutely. That's been extended for a further 3 tax years up to 2031. So a higher rate taxpayer, that threshold is 50,270. So any earnings above that, you're paying at a higher rate.
And to think that they're going to be in place for another, it feels like it's 6 years from now.
Yeah.
And we know what inflation's like. So I suppose people, when their wages are going up, they're going to potentially end up not just going up and paying more tax, but actually going into a higher tax bracket and paying more tax as well, aren't they, over that period? So
that's both for employees and people receiving pensions.
Yeah.
2% on your dividends, property income and savings, which we mentioned earlier.
So there was a lot of rumours, wasn't there, prior to the budget about how people that earn property income would be taxed. And there was even getting thrown around, for example, could national insurance be put onto property income? Now, she hasn't went that far, but by putting that 2% on it, she's almost went part way, hasn't she? And recognised that ultimately people have rental income, savings or investments, they're paying a lower rate. So she's put that extra 2% on there, hasn't she?
That gap. Interestingly, there was a lot of noise around pensions. We were hoping didn't come off and actually didn't, in terms of those that are able to put more money into pensions, make pension contributions themselves into their personal pensions. So there was no changes in terms of the reliefs or, when you come to get your lump sum, for example. But what they are changing is the salary sacrifice amount. So they're going to cap that at £2,000.
Which I suppose you can understand. I think from my perspective, though, I think that what it'll mean is a lot of small, medium-sized employers that we act for that have ran salary sacrifice pension schemes, they're almost going to think it's not worth the hassle anymore because those calculations, if people start to earn over that, it adds another level of complexity. So what I think we could find here is a lot of people are just now not going to benefit at all from salary sacrifice on pensions.
Well, what has happened, in the past is, let's say you've got an individual earning 50,000 and they've got the opportunity to have £5,000 additional bonus. Well, they're going to be a higher rate taxpayer. So what could have opted was actually, tell you what, put that into my pension for me instead.
It's gone
That's
now.
going to affect all of that.
Gone, hasn't it? The benefit's gone.
So ISAs.
ISAs from today's budget. So I suppose there's the current amount where you can put £20,000 each individual into a ISA during the tax year. And you've had the option of that being a cash or a stocks and shares ISA. And they put a restriction on there, or they're going to put a restriction on that from April 26 for under 65-year-olds, whereas in the cash aspect would be restricted to 12. And then if you're going to put more than 12 in, it has to be in a stocks and shares ISA. There was then changes announced, wasn't there, for electric vehicles, close to my heart, seeing as how I've got an electric vehicle, which a lot of clients like to take the mick out in one way or another. Yes, taken for tax purposes. I suppose what it's been mentioned, though, is that from April 28, they're going to introduce a rate per mile on electric vehicles and hybrid vehicles, 3p per mile for electric vehicles, 1.5 pence for hybrid cars. It's an interesting one, that, really, because I can understand it with the lower road tax that some electric vehicles pay, but people have been incentivised to be buying and going electric, haven't they?
So
what's your take on it?
I think it's just going to disincentivise people. I've had conversations this week when it was, leaked, there was this potential to increase this and apply this levy, and they were saying, well, it just seems a bit bizarre. So all this time encouraging people to go electric, and now it's like, we'll add this.
We're going to add a tax onto it.
So I think if the conversations I've had, it definitely is going to disincentivise.
I suppose look at it, 10,000 miles, it's £300 extra tax that you're going to pay per year. It's still extra tax that you're going to pay. And I suppose, I don't know about you, but a lot of the calculations that I've seen when people are trying to weigh up, is it tax efficient to get an electric vehicle? Or actually, sorry, not tax efficient, the cost of ownership. Electric vehicles are more expensive to buy compared to other vehicles in the class. Adding in this extra bit, it could just be the bit that tips people not to buy EVs and maybe stick with the diesel or petrols.
Yeah.
Yeah. So with that in mind, is there anything that people should be looking to do following this budget to plan ahead?
Yeah, and like I would just say to anyone not to panic, not to worry. You know, we'll have a look at the devil's always in the detail, like you said earlier. So we'll be looking at the Treasury notes in detail to get the exact details. But ultimately, plan ahead. You know, speak to us. You know, get in touch with us. Speak to one of the team. We'll also be putting details on our website and social media.
Yeah.
So once all the dust settles and we get to see the exact detail, we can have them meaningful conversations with businesses, with individuals, see how it's going to, you know, impact them and plan ahead. And there will be changes going forward to try and mitigate the cost to them.
Yeah, and if there's any relevant advice that we feel is applicable to them, then we'll be getting in touch on a case-by-case basis, won't we?
That's right.
To make sure that we're minimising the impact of any of these changes or any adverse things on the businesses that we work with.
Yeah, so naturally as a firm, we will be looking at these things for our clients individually, but if anyone does want to speak ahead of time, then that's fine.
Yeah, get in touch.
Yeah.
Yeah, well, thank you for listening to us today about the budget. If there's any questions that you do have, get in touch with myself or Sarah or one of the team in the office and we'll be more than happy to help.